Now, without any further ado, I'd like to introduce our very special guest today, the legendary Joshua Friedman. Josh Friedman is the co-founder, co-chairman, and co-CEO of Canyon Partners. Josh is a graduate with distinction of Harvard College, Oxford University, Harvard Law School, and Harvard Business School. And prior to forming Canyon, Josh was director of capital markets at Drexel Burnham Lambert. And prior to Drexel, he worked in mergers and acquisitions in Goldman Sachs. Along with his co-founder, Mitch Julis, Josh is the recipient of the Institutional Investors Lifetime Achievement Award and the Ellis Island Medal of Honor. Philanthropically, Josh is a member of the board of directors of the Harvard Management Company, the Harvard Law School Leadership Council, and the Harvard Business School Board of Dean's Advisors, among his other roles at the university. He also serves as a trustee for the California Institute of Technology, Caltech, the Los Angeles Philharmonic, the UCLA Hospital Department of Neurosurgery, and the Los Angeles County Museum of Art, LACMA. And he's also the chair of the Caltech and LACMA investment committees. Ladies and gentlemen, it gives me great pleasure to welcome the one and only Mr. Joshua Friedman. Josh, thank you so much for joining us. I'm really excited for this conversation.
Well, thank you so much for having me, and thank you so much for sustaining a great relationship over many, many years.
Yeah, no, listen, well, speaking of relationship, I must say, I think that the only thing missing from your bio is that you also have the great distinction of having Prime Quadrant as an investor. But I won't hold that against you. I know that there are many other distinctions. Anyway, but in all seriousness, just before we get to your exceptional career, I just like to talk to you about your educational pedigree. So you have this undergrad in physics from Harvard, master's from Oxford in politics and economics, this Harvard Law degree and Harvard MBA. So all that's pretty remarkable. How did that come about? What was most impactful about that educational journey? And I'm also curious whether your parents got over the fact that you didn't become a doctor.
Well, it's a good question. So when I was a kid, I grew up in a family where my dad, we had middle class upbringing. My mother was a school teacher, like Mitch's parents. My dad did not graduate from college. He was drafted into World War II. And I think he looked around him and he really wanted us to have financial security. He grew up in a family where he didn't have that. His dad passed away when he was very young and they had no money. And I was very, very good at taking tests. If I had to pick a career and what I am best at, it would be taking exams of all sorts. I could do math exams or physics exams or law school exams or whatever. I'm good at taking tests. So I did well in school. And my dad, because he was from Boston, and maybe it's the only really good school that he'd heard of, from the time I was a kid, he said, you have to go to Harvard, you have to go to Harvard Law School, and you have to go to Harvard Business School. And when you're done, don't be a lawyer. He said, you have to have your own business. You've got to have your own business. Everybody who does well has his own business. And, I would ask my dad why. And he would say, well, if you work for other people in this town, and remember, this is Boston, Massachusetts in the mid 60s. He says, people are very prejudiced against short people and Jews. So if you don't have to work for people, you don't have to worry about that. So my dad pushed me like crazy to do well in school, pushed me like crazy to get education, but also pushed me not to take a conventional career path.
Yeah, wow. I'm sorry to say I'm guilty on both fronts. I hope I don't have to look for a job. Yeah. So okay. So you went you went from this educational journey to Goldman Sachs, and you were a rising star there, and even worked for our mutual friend Stephen Friedman, who later became the chairman of Goldman and the chair of the New York Federal Reserve. And then, as you were rising up the ranks of Goldman, all of a sudden you left to some small no-name brokerage firm with Michael Milken, who nobody knew at the time. Seemed like a fairly radical transition. What motivated it? How did that come about?
And honest to God, I think Steve hadn't heard of Mike. And, I really, the Wall Street thing was in some respects a detour from my plan, because I was a physics major. I did all this business and law stuff, and I thought I'd run some startup out on Route 128 outside of Boston, some tech company as tech was defined back in the early 1980s, which were all these electronics, signal processing companies, and all sorts of super interesting electronics-based companies out there. And I'd work for them during the summer and so forth. But I somehow got seduced into this Wall Street thing because that was what everybody at business school wanted to do. And being competitive as a student and, competitive as a kid, that seemed like the Goldman M&A department was the job you wanted. So I did that. And I was on that track and everything was going great. And Mitch had been a bankruptcy lawyer and he had quit bankruptcy law. He hated practicing bankruptcy law. And so he left and ended up somehow stumbling into, he was writing freelance articles on how to invest in a recession. And he decides he's going to interview these guys on the West Coast who are doing these things called junk bonds, which at the time were not, there was no such thing as a new issue junk bond. Junk bonds were investment grade bonds that had gotten downgraded or were in bankruptcy. So he wrote this article and they said, geez, we never get to interview guys like you. Why don't we interview you instead of you interviewing us? And to make a long story short, he became an analyst there. And then Mike needed somebody to work in capital markets, eventually run that group, which was where all the action was on the new issue side. That's where the buyout firms, and it seemed to me like if I wanted to have my own business and I didn't have any money, I should know how all these other guys with no money are figuring out how to buy these huge companies, because that was Mike's gig. It was all these people with great ideas who wanted to raise capital and buy things. So I said, if I don't leave now, I'm going to have such golden handcuffs at Goldman Sachs, then I probably never will. Right. So I thought about it and I went out and I talked to Mike and I talked to his brother Lowell and I talked to a few of the other partners there. And I left my job as budding vice president. I was an associate. I was about to be a vice president at Goldman. I left to become a partner of Drexel's in the high yield group. The high yield group was like its own business within Drexel. It was extraordinary. And I knew exactly what they were doing there. Not through Mitch. I knew it before that because I had been tracking all of these guys doing bootstraps and leverage buyouts in the 70s and early 80s, the Daryl Ruttenbergs of the world, if you remember that name, Studebaker Worthington. I mean, Bessemer was doing bootstrap transactions. Those were buyouts. KKR was barely born. It was born in the mid 70s, but it wasn't really, they didn't have a fund where they were cross collateralizing their deals for years. And there were, so to me, this was the epicenter of entrepreneurial deal activity. And I really didn't want to be at either one of these firms. I wanted to do what my dad said, which is have my own business. And where better to learn how to do that than to go work for Mike. So that's what I did. And it was regarded as insanity at Goldman Sachs. They thought, and it wasn't like today where everybody leaves Goldman Sachs. And it wasn't like people left Goldman and even started their own businesses. It was you worked at Goldman, you had a career, you had a lot of money, it was a prestigious job, but it wasn't like today's velocity of human capital. Right. So this was regarded as it was sort of a little bit of all of a sudden, I became famous at Goldman Sachs because I left and people were like, you hear about this guy who left? Oh my God, it was in the merger department, Steve Friedman's guy. And that wasn't what I was trying to do at all. And I said to him, this is like a phenomenal firm and a phenomenal seat, but this just kind of fits my dream. And if I don't chase it now, I'm not going to chase it. Right. And so that's what happened.
And so just before we get to your own business and how you started it, I just want to double click on something cultural at Drexel. And, I've asked this of Howard Marks, I've asked this of Leon Black. Somehow Drexel produced alumni who sit atop the leading institutions in private markets. I mean, so when you think back about, and again, you guys literally created the high yield bond market, and shaped that market in those days. But when you think about the culture, the training that you and your peers had to launch institutions like Oaktree and Moelis and Apollo and Leonard Green and Jeffries and Ares and of course Canyon, what was it like? What was it within Drexel Burnham that kind of facilitated that entrepreneurial spirit, or did it just attract the entrepreneurs? Like culturally, anything that comes to mind?
Mike is an extraordinary once in a generation guy. He just is. And, he had this idea, there were probably 300 companies that could raise money in the bond markets, public bond markets in the US when we started and when he started it. And these are, investment grade companies. There was no such thing as a new issue high yield market. If you were rated below triple B, which is the wild majority of all companies out there, you had two choices of how you get debt capital. You go to commercial banks, or you go do a private placement with an insurance company or a pension fund. Mm-hmm. And it's like brain damage doing a deal with an insurance company or pension fund. And now you have these leveraged buyout firms that are figuring out clever ways to finance all these individual assets. And Mike's figuring out, well, the characteristics of this company from a credit perspective are a lot better than the characteristics of this investment grade company that's been downgraded. Right. And the trajectory on that one is down and the trajectory on this one is up. Maybe we should just print a deal for them. Mm-hmm. The amount of impact that innovation had on the capital markets. I know many of your clients, I hope many of the people on the phone are people who've been successful entrepreneurs. Having access to public or even private credit markets where you can access capital at an affordable price quickly, that's commensurate with the risk that you're really taking, as opposed to just being kind of blackballed because you're not investment grade and being relegated to sit for 3 months with some guy from Teachers Insurance Company. And nothing against teachers, because they started buying high yield bonds too, because they saw the magic of it. And to create that marketplace was Mike's vision. And what it did, of course, as a result, because really the clients were the buyers, but it attracted every entrepreneur in America, some of them good, some of them bad, some of them honest, some of them not so honest, some of them reliable, and you learn pretty quickly. And the amount of creativity it afforded us, because we're structuring all these deals and figuring out, well, how can we solve this guy's problem in the context of this emerging market that we're creating? It was a mind-blowing time. We were moving 1,000,000 miles an hour. Everyone else on the street looked down their noses at what we're doing. They called it junk bonds instead of calling them non-investment grade bonds or high yield bonds. That became a thing. None of them wanted to be in the market. Morgan Stanley tried to get into the market, and the first 3 deals they did defaulted before the first interest payment was made. People Express Airlines, Oryx Energy, and I forgot the third one. And they got back out of it. And then as soon as Drexel was gone, it was like Ken Molis told me. He said, they thought they killed the dandelion when they killed Drexel, and all they really did was blow the little spores all over the place. And now they're growing everywhere. And so every firm got into the business, and most of the businesses led by former colleagues of ours at Drexel.
Interesting. So that's actually a great segue. So, okay. So I love that analogy of, those little bits of the flower kind of sprinkled throughout. So so Drexel falls, then you and Mitch kind of are start Canyon in, I believe, 1990. You're realizing your entrepreneurial vision. Could you share with us what your vision for Canyon specifically was at the time? And, as you reflect on that journey, what were some, how is that vision different, or how has it evolved today?
Oh, we didn't know what we were doing. Honestly, I'm not being falsely modest. We didn't. We knew what we did well at Drexel, but so here we are trying to start some business. We didn't know what it was going to be. We actually had a few other guys with us as well. So we started with 5 people and eventually winnowed it down to the 2 of us. We weren't immediately successful at it. The first thing we wanted to do was we needed to kind of get the business going. So we put a little bit of our money into a pool. So we had overhead money, hired some people. And we thought if we do advisory business, that brings in fees right away. So we were doing restructuring advisory on the one hand. So companies that were in financial distress weren't going to be able to pay their interest. We would advise them on how to restructure their bonds. We deal with the bondholders, et cetera. And that produced pretty good fees. And in many cases, sometimes ultimately merger fees, because the ultimate solution was, restructure the debt and then sell the company. You get the best price you can. So we're pretty good at that. We hired some people to help us, and we made some real money on that, and had some great clients from Citicorp Venture Capital, which was a huge leverage buyout firm at the time, to Rupert Murdoch at News Corp, trying to buy the store or TV stations out of bankruptcy. So we had good relationships at very senior levels, and that produced a lot of fee income, which lets you hire people and pay for the lights and the rent and all that stuff, and maybe make a little bit of money. What we really wanted to do was manage money. So the other side was we wanted to take advantage of the fact that there was this super distressed market going on, not necessarily distressed in the sense that the companies were bankrupt or near bankrupt. But remember what I was saying, that no other firms were in this market. Drexel had probably, I don't know, 70% market share. They used to say 70% market share. I think it must have been 90 of trading of all high yield bonds. And now Drexel blew up and it's gone. And you have all these institutions that own bonds. And if they want to sell something, there's no buyer. They want to buy something, there's no seller. There's nobody in the middle of that process. So it took time for the market to recover. So prices plunged. There were many institutions, insurance companies, savings and loans, endowments, foundations, et cetera, who owned bonds. And they wanted to sell them. And it was a rough time to do that because there was no market. So what we did was we decided that we needed some capital to take advantage of these low prices. And it was a time when, interestingly, it was a time when the economy was coming out of a deep recession, 1990. And so company results were going vertical at the same time as the bonds were ridiculously cheap. So, and we didn't have any capital to take advantage of it. And I remember when Leon Black got his deal done with Credit Lyonnais, and he got like $400 million, and he's trying to buy stuff like crazy. Like, whoa, we have to get some capital. So that second side of the business. So initially our vision was, okay, we're going to do advisory work and we're going to do investing. But we didn't know where you get the capital. But we did manage to talk three institutions. One was a foreign bank, one was an insurance company, one was a sort of a hedge fund that gave us a sleeve to manage, to giving us capital. And it was all buying stuff at big discounts that were clearly money good, or could be, if they weren't, could be restructured and make a lot of money. Very complicated, buy things when they're complicated, clean up the capital structure, sell them when they're simple. And we had huge returns on those managed accounts the first 3 years. The problem is they were finite duration. We didn't have a fund. We had managed accounts, and it was like, okay, here's the money for 3 years. And we earned like 60% IRRs and that stuff. It was fantastic. And then we decided, okay, now we need to raise money to start a fund. So we started that in 1994. It was the first time we're doing a commingled fund. We had no idea who even asked to put money in a hedge fund. George Soros wanted to fund us, but he wanted like a huge discount on the fees. He wanted to get all the trade tickets every day, et cetera, et cetera. So, it was just like, I said, we want to have our own business. We don't want to be a subsidiary. We probably could have shortcut a lot of it if we had taken that money. So we started with like $17 million. It was half our own money. And then very soon it got bigger, and then it got smaller, and we sort of found our footing and figured out what we were good at. And then we said, we don't like the advisory business anymore. So our business plan was all over the place. It was advisory, it was managing money. And then eventually we said, we just want to manage money. We want to have funds that are of institutional quality, where we're known for being extremely strong on complex credit analysis. We want to be in the very top high value added part of that credit world. And we want to be known for having, the highest ethics in the business. And part of that may have been a reaction to Drexel blowing up. But the fact is that I think Mitch used to call it ethics and effectiveness. That's what we want the firm to stand for. So we started focusing on culture pretty early in terms of how you create a replicable business plan. So that was a long answer to a very short question.
No, that's great. I mean, look, I think I was going to ask you about how you got into focusing to credit, but I think you covered that a little bit. I want to get into the distress side, and you guys ultimately became known as one of the leading distressed investors in the world. And I think back to some of the distress situations, which we've been the beneficiary of as your investors through, Lehman debt and Caesars debt and Puerto Rico debt and all of that. But I guess the question I would have for you is a little more broadly. Why don't we see opportunities in distressed debt today? Like, why don't we see more of it? Like, so many industries have been affected by COVID, and obviously the Fed and Treasury have staved off the worst of the crisis by printing and investing trillions of dollars. But did that just defer the distress? Are we still waiting for those opportunities, or did it fundamentally change the game in some way?
Well, first of all, the economy was booming before COVID, so we didn't really have a cyclical downturn. We had an economy that was going straight up. It got hit by a baseball bat. And so you had people who said, I don't know how wide the river is, but I got to get from here to there. And the Fed jumped in with both feet, and the Treasury jumped in with both feet.
Right.
And when you suppress interest rates sufficiently through very forceful fiscal and monetary policy, and that process started in 07, 08, or we've had nothing but very accommodative policies that have basically kept interest rates extremely low, and the economy has been growing quite well. You have low rates, and you have and what the government is telling you with low rates is they're basically saying, we want you to go out and take risk because you can't earn any money on your debt. So forget investment grade, which doesn't yield anything. Today, you even have high yield that doesn't yield much. I mean, we don't do straight high yield bonds. We do more stress, distress, complex situations, acquisition financing, et cetera, today, because the general high yield market trades at such tight spreads and such low yields that literally 85% of all high yield bonds trade at a lower yield than the last inflation numbers. So if you just buy a high yield bond and you hold it, you're giving up real value. So that's not to us what's interesting. So why is there so little distress? Well, all that activity to keep rates down forces people, it forces the bear out of the cave, or it forces the person. Actually, as one of my friends described, he says, it forces you out of your cave to go hunt for the bears because you can't just sit in your cave and survive. There's no food growing in there. You got to come out and take risk. And when you take risk, you're buying equities. And you might get your head blown off. You might do well for a while. But right now, clearly, we're in a market where people are taking much, much bigger risks at much higher multiples with earlier stage companies, and people can print equity all day long.
Right.
And the economy is bouncing back quickly. So there's not a lot of distress in the regular corporate world. There are pockets of distress. It's just not in regular corporate public companies because those companies have access to the equity markets. The debt they raise has low rates. And because there's so much money chasing anything with a yield, investors in the public markets are willing to endure very poor covenants. So even if a company is slipping up, they might not trip a covenant for quite a while. And as long as their rate's low, they'll just keep putting things off. And maybe by then they'll be able to sell a division because prices are super high. Maybe they'll be able to raise equity because equity markets are high. So we'll just have to wait a while to see the corporate distress. But there is in certain other pockets, particularly in areas of real estate. But we can get into that later.
Yeah, no, and I do want to get into that. I want to just double click on something you said. So you said that the 85% of high yield bonds right now are trading below the last posted inflation number. Now, and by the way, it's just I suspect that's even before today's announcement. And I think if you probably saw that CPI gone up to 6.2% or something like that in October. Certainly higher than anticipated.
Yeah, it's actually probably a higher percentage. I was using the old one, the 5.4, and I haven't gotten the percentages yet. But at the 6 point whatever, it's got to be 90% plus.
Yeah. So like 90% of the bonds. So again, there's the issue of how to think about high yield, but then there's the other issue of this inflation that we're seeing in every corner of the market. How are you thinking about inflation going forward, and how does it affect your various strategies or your decision making?
Prior to this big V-shaped, sort of demand recovery, we were sort of on this knife edge between inflation and deflation. And it looked like the deflationistas were winning over the inflationistas. And so I'm a little agnostic on this. And what we try to do with our portfolio is figure out how can we protect people as opposed to how can we predict how long is this going to last. I've been saying for a while, I sort of think that this will pass, but it depends on some things. And second of all, I think in the short run, it will last longer than people think. And it will last longer than people think because you have, you had the government paying employees to stay on the sidelines. You have a huge resurgence in demand because people are cooped up and they want to go out, they want to travel, they want to do this, they want to buy things, they want to be social, they want to shop. Believe it or not, malls that looked completely dead are now leasing new space again. So people want to get out and do things, and people and they want to buy cars, they want to do this, they want to do that. But we've been in a world where supply chains, thanks to the magic of the internet and thanks to the magic of extremely low cost data in massive size, supply chains are really tight. In the old days, you'd have inventories piled up everywhere because you didn't have this logistics chain that was all running like a top where everything could be just in time this, just in time that. Look, Michael Dell made his initial fortune because they didn't have all those inventories in the system. Interest rates were higher. The cost of maintaining inventories was enormous. They didn't have inventories. Everything was just in time. You made an order, they bought the parts, boom, and put it together. It was a different model altogether for computers. Well, that's taken over in so many businesses today. Now all of a sudden you take a baseball bat to the economy, and everyone shuts down supply. Now demand comes ripping back, and go try turning on the supply chains, and we're seeing what happens. 100 plus ships sitting on the ocean outside of Long Beach. So that's very, very inflationary, because it creates, what always causes oil prices to spike. What causes oil prices to spike is that supply and demand are vertically inelastic curves. If all of a sudden supply gets shut off, it can cause the price to go way up, because the point where the two curves intersects, just a little shift makes it go way up. Right. What happens if demand shuts down? It can crash. Well, in the short run, you've got to drive your car to work, so you need gas, whether it's there or not. In the short run, you can't just turn on an oil well. In the short run, you can't just all of a sudden produce semiconductors and actually physically, logistically get them to the car manufacturers. So the short run inflation, I've thought for a while, is going to be pretty significant. And it's compounded by the fact that usually when an economy starts to come ripping out of a recession, the government, it's like a big ship that's going through a canal, and it's heading to the wall of recession. So all of a sudden the Fed lightens up, and the Treasury decides to spend a little extra money and go into debt and pay people and get to stimulate demand, and the ship starts to move back to the center. But it's like a big ship with two little rudders. If now the ship is already heading very much toward the other wall, right? Demand is coming ripping back, and instead of steering back toward the middle and maybe saying, hey, let's take our foot off the gas pedal a little bit, particularly on fiscal and monetary policy, we have both feet on them full blast. And so we're going straight into that inflation wall. Now, eventually, that'll change. And on the other side are the deflationary factors. Number one, the Fed is starting to take its foot off the gas a little bit. Treasury can't do that so easily. Once they've spent your money, that debt doesn't just vanish. If the Fed shrinks its balance sheet, it shrinks its balance sheet. But Treasury can't do that. Also, we have demographics that are somewhat weak. We have an aging population. We'll see what happens with immigration and job training and things like that. But right now, demographics are sort of weak. We have big debt balances. That's a deflationary, kind of suppresses the economy in some ways. And productivity increases are enormous, and we underrate those. As of a couple of months ago, when we were just surpassing the GDP run rate from pre-COVID, we were doing it with 8.5 million fewer employees. That's a very deflationary force. You're producing more stuff with less cost. So there are. It's not so clear. I do worry that pervasive money printing is eventually inflationary. We'll see. It depends on the velocity of that money. It depends on demand. But overall, I'm sort of the view that inflation will be stronger in the short term, but it may surprise us on the other side in that it proves to be a little more transitory than some of the panic guys about inflation are asserting. But that'll depend a little bit on debt and spending.
Yeah, no, and I had this conversation with Mobius, and who's sort of in the deflationary camp, and it's a fascinating debate, but certainly the data in the short term doesn't lie. And I would wholeheartedly agree with you. Let me ask you, just aside from the supply chain issues and the deflationary risk that you mentioned, are there any other risks that you're particularly concerned about today, like when we're thinking about whether it's valuation or tax hikes or GDP growth or geopolitical concerns?
All the above. I mean, you have to think about we're not macroeconomists, but as I get old, I get on panels, there are things or interviews that use the word legend and stuff like that. I also, which I can't, it's kind of a head scratcher for me. And also people ask you about macroeconomics, like more than they do. But and we're very much micro focused. But I think there's a lot of risks. I think that are we witnessing, the decline of U.S. civilization, big picture? Maybe we're losing a lot of the magic bullets that made the U.S. the wealthiest country per capita in the world. I think that when you start taxing people where marginal rates are start approaching mid 60%, which could happen if this tax bill goes through, at least in the coastal cities, it produces big disruption, and capital finds other places to live. It will find other countries to live in where it's more friendly. And so you need it to be friendly to business to create jobs for everybody. So these are big picture concerns. Equity market valuations are absolutely a concern. They're partly so high because of all the things we just said. The government has moved those rudders to basically tell you can't make money buying standard fixed income. And that really is so we're not necessarily predicting that equity markets will crash. I think there's a lot of demand. The economy is doing well. People are coming back to the workforce when they get off of the benefits that they're being supplied. But if we go so far on the progressive agenda that we produce wild amounts of debt and we don't have incentives that are consistent with what we've had historically, I worry about that. Mm-hmm. The puzzle for you and for us as investors has always been, okay, sure, we want to be part of the incredible growth and incredible displacement of traditional businesses that has been enabled by massive quantities of zero-cost data, right? The disruptions pace is faster than it's ever been. So we want to be part of that, right? That's not necessarily what we do for a living, but if people want to have a ton of money in venture capital, great, they should. We saw the rewards in the endowment world of that. But when the portfolios start getting tipped so heavily in that direction, and you start seeing less experienced, less well thought out, earlier stage business plans get funded at prices that are crazier and crazier, there's going to be a comeuppance at some point. Mm-hmm. And if you think of your portfolio in old-fashioned terms, people would do, I've got 60% stocks, 40% bonds. Then we created alternatives, and we had hedge funds, and we had other types of absolute return strategies, and we were a big part of those types of things. Our job in life is to take care of your 40%. How can we get you to earn a return that's well above the inflation rate if this inflation turns out to be pretty pesky and sticky? How can we make sure that in a rising rate environment, we can create things that are going to get people, a point or a 3/4 of a point, a point and a quarter, but with great reliability every month? How are we going to do that? And it takes a lot of creativity and very different strategies today from the types of strategies it took a year ago or 5 years ago. And that's the challenge that we're always trying to face, is how do you adapt to that world?
So if we could expand on that a little bit, and you guys, Canyon, invests across the capital structure, across different asset classes. Among all of those, where are you seeing the most compelling opportunities today? Like, where are you seeing those creative, innovative, unique pockets where you're capturing that spread, so to speak?
There's several things. Some are new and some are old. You mentioned distressed. Distressed is always fun because it's always a transition. You have holders who bought something when it was good and now it's terrible. So they puke it, which is a fancy word for selling at a really bad price because they can't deal with the complexity. So in the distressed world, not that much corporate. As you said, there is a lot of stuff in the sort of 6th or 7th or 8th or 9th inning, like Puerto Rico, we have probably 13 of these, all the old oil rig restructurings. There's just today, there was a big merger between Noble and Maersk. Great transaction. Should be good for both situations, I think. But in terms of current distress that has really high return opportunities, the areas where we see that, and it's a small part of the business right now because the economy is so robust, is really in some real estate sectors. So we were the largest creditor. If you look at real estate, multifamily, not distressed at all. Industrial, not distressed at all. But if you look at retail malls, particularly B malls where the anchor tenants used to be JCPenney and Sears and Kmart, a lot of trouble. So CBL is a public company. It's a REIT. It owns dozens and dozens and dozens of secondary malls that used to have those kind of tenants, now have holes in the mall. That's terrific restructuring opportunity. And we're very involved and, very much with our sleeves rolled up as a large creditor there. So is Oaktree and PIMCO but we're the largest creditor in that. And so malls is one area. We're seeing it in hospitality. That's not going to bounce back quite as fast in the hotel business. And we're also seeing it office because the use of the office and where people go and which cities are dominant, that's changing too. So it's not just going to bounce back just because COVID is gone, if COVID is ever gone. So 3 sectors out of the 5 in real estate, office, hospitality, and malls, retailing, are sort of have pockets of distress. Other areas the one area I would mention, though, in addition, that has really been the most prolific area for us right now has been what we sort of call it capital market solutions or direct lending or private credit, but our version of private credit, which is the private equity business has exploded. So there are so many leveraged buyout firms and venture firms, just gigantic quantities of private credit. And all of those people who own those firms and work at them, they're tasked with the job of putting that money to work. They don't make money sitting on their hands. So, right. And it's competitive as can be. And because it's so competitive, there are many, many situations, if the sponsor trusts you and you can handle them one-on-one in a confidential and completely open and honest and trusting way, where you can provide them financing quickly, confidentially, and with very, very good rates of return to solve the short-term problem of how do I make sure I show up at the doorstep with all the cash 100% committed. Mm-hmm. They don't have time to go to the high yield market. They don't want to be public because maybe they're buying something. They don't want it to be known what they're doing because maybe they're buying a division of a public company and they don't want competitors to parachute in. Because competitors who don't even know anything about the company will indicate a higher price just to disrupt the process to see if they can get in it. So right. The number of these acquisition financings we structure them to be very high cost, but for short term, so that the sponsors go, okay, I get it. I'll get you your, low to mid-teens return. That's fine, but I need to be able to refinance you in 6 months and replace you with the public high yield market. Now that once I own the company and the dust is settled and I have the luxury of time and I can refinance you at 5% or 5.5% instead of 14.5%. Yeah. So that area is booming right now, and capital is starting to pour into that area as well. We've changed our approach in the sense that used to be done as one of many pods of activity within our hedge funds. We had distressed, we had the private lending, we had merger transactions, arbitrage, some equities, et cetera. The flow of that is so high, and these are not always the most liquid loans because they're not broadly syndicated, that we're doing some of that through separate vehicles now that are designed for that purpose specifically.
That is very interesting. I want to go back to something you said earlier, because I get some of the families on the call probably be curious, particularly with the real estate and office and hospitality, we could sort of all wrap our heads around. But particularly if we go back to retail and malls, and you mentioned that people are getting out now and coming back to malls. But again, I think over the long term, how do you establish conviction in that paper, in that debt, and that it's not really a falling knife situation that you're sort of catching your way down?
Well, I mean, because like in CVL, which is the mall retailer that I was talking about, because of the low price we paid for the debt, and then some assets we get that are free and clear that we know we can sell, you end up creating the malls at like a 20% yield in the world of real estate yields that are in the threes. Okay, right. That means what the world is saying is this asset's going to die. They don't think you're going to get that yield for that long, and we agree. We don't think we're going to get it that long either. But the reality actually right now is they're not dying, and we're signing new leases because people want to shop, but they will die. You have to basically roll your hands up and have a good real estate team that can say, what are the alternative uses? One property, we just replaced the anchor with a casino. That's completely changes the character of the mall. Many of these malls, because they're older malls, are toward the core of a mid-sized or smaller sized city. And the last thing the city fathers want is a blighted mall there. So you can get re-entitled, you can partner with developers. Most of them become multifamily. We just saw a big mall in Los Angeles that's being torn down to put a huge Google facility. So things have to be repurposed. And traditional bank lenders who made a loan against a mall aren't necessarily the ones to be doing that. Right. And it's a very high value added activity if you can create the property at a low enough price. So that's the kind of thing we try to do there. There are other things, though, that I think, I had a little conversation with you about CLOs the other day, that's probably a little complicated and technical for a bunch of entrepreneurs who sold their businesses that aren't financial people. But, you have a portfolio of bank loans that yield L plus whatever, and you finance that just like a bank finances a balance sheet full of loans. And if you do it right, you can get AAA debt at L plus not much, and you make a spread. That spread has stayed the same now for the last 5 years. Every other spread is compressed. That means that the equity in that, which is almost like owning a little piece of a bank, has enormous cash flow and very high yields. You can only put a certain amount of money in that. There is the stressed and distressed stuff. There's the new loans. So there's a lot to do. And there's also a lot of merger activity now. So right. on the stock side of the book, as opposed to the bond side of the book, there are a lot of situations where somebody makes a bid for a company and there's a spread in there. You can buy it, and as the deal closes, you make money. And sometimes the spread's too high because their perceived antitrust risks are higher than real antitrust risks. So the deal will close. It just might take a little longer. But I wouldn't call it. It's not like the target-rich environment that we had for a few weeks in the middle of last year, where everything traded horribly.
Yeah. No, I get. I mean, this is first of all, obviously, we're invested in that CLO strategy, and so
yes, you are.
We're quite excited about it. And you're right; it has remained remarkably consistent.
Actually, your second one is making a little more money than your first one, but they're both mid to high teens. So that was a smart strategy then, and I think it's one that persists. Other strategies like corporate distress, we're going to see less of it.
Yeah, no, I think it's great. I want to get a little bit more personal on this one, and if I'm not mistaken, I think we were talking the other day. You mentioned that your son joined you in the family office. So other than your investments in the various Canyon vehicles, which I know are considerable, how are you and perhaps your son thinking about investing your own capital? And maybe the way I'd frame this question is, if you were completely unconstrained and you were starting with an all cash portfolio today, how would you construct your own asset allocation today, and why?
Sure. Well, that's a good question. I mean, I've had the privilege of sitting on a lot of endowment boards. I'm on the investment committee for I was on the committee for the J. Paul Getty Trust. I just got off of that. And I am on the Broad Foundation, which is a pretty innovative one. And Lincoln Center, I chair that one too. Not Lincoln Center, the Mellon Foundation. I'm off of some of the ones you mentioned earlier. I've kind of
okay.
I'm trying to rotate out of some of that California stuff now that I moved to Texas. But I see this asset allocation in real time from people who are not as constrained, and it's a topic of constant discussion on some of these boards. Family's different because you have to determine your asset allocation a little bit by your own circumstances. Some endowments have the ability to be very, very long-term in their focus, so maybe they can have more stuff that's locked up and private equity oriented, et cetera. Others are people who are older and they don't want to, while they might suffer from a lot of FOMO and they see all the stuff turning and burning and crazy levels, they do need more safety and security, because we've seen this movie a little bit before. Yeah. I think that the challenge, what we're trying to do is, again, I think about it a little bit in old fashioned terms of that sort of 60-40. Okay. People would say 60% equities, 40% debt. There was no magic to that. Some people might tilt it heavier or lighter, but it's a good starting point. But the debt doesn't look like, to me. So for me, I have all those alternatives on the 40. That's like what our distress funds do. It's what our hedge funds do. It's what our CLOs do. It's what our direct lending funds do. These, and those are all designed to be producing, very, very high risk adjusted returns, but not very, very high returns. Like, they're not going to compete with what you're going to get in your private equity fund or your venture capital fund, or even public equity.
Today, when I see large private equity sponsors underwriting at single digits unlevered, I'm not sure. I'm actually not even sure about that anymore. But anyway,
from this point, that's right. But as an asset class, equity should yield more than debt. I've
Sure.
always been probably significantly underweighted on equity, particularly underweighted on private equity, because I'm doing stuff that I'm completely comfortable with and familiar with. That's in the credit space that I know is going to squeeze out those pick a number, 8 to 15%. And every once in a while it's going to have a worse year, and every once in a while it's going to have a better year. But we're sitting in that vicinity generally with our products. So when my son joined us, of course, his comment is, you don't have enough equity. And he's right. And my middle son is a principal at a venture capital firm. And I think the principal's probably there as well. And he says, Dad, you should do more VC, but you got to be careful because it's risky. And he's right. So my older one, who was at Goldman and then was at a value-oriented kind of event-driven hedge fund, he's managing an equity portfolio now. He's allocated to some equity-oriented funds. He's doing the higher risk strategies, but he's pulling his horns in a little bit too, because he's scratching his head on some of the valuation questions. And between him and with some work from my younger son, they've also done more venture capital. So they're trying, and it's not going to be 60% of our book that they're sticking in this kind of stuff, but they're doing things that are very different kind of return streams. They just did a, sort of a oil and gas, kind of call it cash flow drilling type of operation. They did tremendous amounts of due diligence on it and got a great sponsor. And I think that's working out pretty well. They've been involved in some of these more recent opportunistic rounds that have taken place in the VC world. But I think the first job of my son was doing was just getting more pure stock exposure. Good old fat, not, sometimes through indices, but also from a direct investment portfolio that he has that's maybe more growthy than what I do, because people should have exposure to that. But I freely recognize we may be all over the capital structure, but we're basically focusing on much more conservative, more stable types of stuff. And so we're not going to be your whole portfolio, nor should we.
Right. Yeah.
MIT wasn't up 50% this year by being all in, low vol stuff. We're lower vol.
And so I'm actually, again, I want to just double click on that a little bit. Your son is in venture.
That's the middle one. He's not the one running the family office. He's very full-time engaged in his stuff.
Yeah, no, I'm cognizant of that. But I was actually curious from your point of view. Your son, here he is. He's working with a very notable sponsor. But as you travel around the world, and we were talking the other week when you were in Saudi Arabia. But as you travel broadly, you speak to many people, you're involved with many organizations. What trends and shifts and transformations are you most focused on today? In other words, and whether it's geopolitical or technological or financial, what are you most fascinated and excited by today?
I mean, it's hard not to be excited by what's going on in the world of biotech when you see a company like Moderna, born out of nothing, that can figure out how to design the vaccine within days of getting the DNA sequencing for the COVID virus. It's hard. And so I find that area super exciting and interesting. It's not related necessarily to what we do. My son has managed to do some investing in that area, which is a good thing. And it had a huge run up prior to this year. And now it's, they had biotech generally has had a rougher year this year. I think that we're in a world where the pace of change in so many areas has accelerated because it's basically free to have infinite amounts of information. And it changes geopolitical relations. You can, in the old days, you couldn't shut down a nation's pipelines using your computer in North Korea. Today, you can, unless somebody's really careful about how they're protecting it. Because when change happens quickly, the first thing you do is you make the change because you can't compete if you don't make the change. So, for example, let's say you're a retailer. If you're not willing to accept credit cards, you're going to be gone. If you're a retailer and you don't have a website that lets people buy stuff on the website, you'll be gone so fast, it's ridiculous.
Right.
But have you really had time to figure out all the possibilities of hacks and all the vulnerabilities? No, that follows later on.
Mm-hmm.
So we're constantly in this mode of catching up on the vulnerabilities we create. And it makes the world an increasingly unstable place generally. So I think what we love instability because it's what creates complexity and creates opportunity. But we also don't like it in some ways because it's hard. It's very hard. And if you get it wrong, you can lose a lot of money quickly. So, but I think that generally speaking, the pervasive availability of massive computing power at essentially zero cost has just transformed so many industries from biotech to really, across the world. And our job is always to find out where has there been just enough disruption to create opportunity during the change, but not so much disruption that we're going to buy some company that's in the buggy whip business and be completely disintermediated.
And how is some of the change, and particularly again with the pandemic, changing either our social or our professional bonds and how we interact with one another? I mean, the fact that we're having this over Zoom versus speaking at our conference, but how has that impacted the leadership or your leadership at Canyon or your culture? I mean, you mentioned earlier you moved from LA to Dallas, Texas. If there's something meaningful behind that move, what was it? What does it say about the time we're in? And again, what's different today than perhaps December 31st, 2019?
COVID is one thing, and I don't think anybody we didn't expect it certainly to be as prolonged and as dramatic as it has been. And it's definitely had some changes, some of which will be permanent on the ways people work. We definitely have a certain percentage of our employees who will be able to work from home or work remotely. It certainly makes moving to Dallas much less of an issue. I'm so accustomed. I want to call, Luke Hall on my phone here, who's on the call somewhere, who's one of our senior colleagues, and I press his number and his face appears on my phone immediately, and it's not that much different from being there, but it is different. Right. So we like to have people in person. I think if you're going to have a culture and you're going to have people treat each other with empathy and with honor and with respect and with grace, it just works better in person. People do things when they're remote and on the internet and on Zoom that it's not the same. So I think that my hope is that notwithstanding all the adaptation that we've made, that most of it will go back to, quote, normal. I do expect business travel will always be lighter than it was in the past. We realize how many things we can do at lower cost. We squeezed inefficiencies out of the system like crazy, which, by the way, is very deflationary. Mm-hmm. And you don't need all the costs you were incurring. You all of a sudden discover when you go to zero-based budgeting and you aren't flying all over the place. So there will be some permanent changes, I'm sure. I'm sure there will be. I was talking to the head of a major tech company that has an enormous travel and expense budget. He said they're going to try to keep it at 20% of what it used to be. They just think a lot of it's not necessary. I'm not sure I agree with that. I certainly think you have to look at somebody in the eyes. You want to deal with people who are honorable, who are honest, and who are diligent and have expertise. And you can get some of that by this excellent, interaction we're having on Zoom, but you get a lot more of it by those impromptu parts of the conversation that involve people who parachute into your office and everything else. So I hope that doesn't change all that much. Texas specifically, this is a very, very business-friendly state. I was talking to one of my colleagues this morning. Almost everybody in this office who came has bought a house. Home prices are roughly 1/3 of what they are in Los Angeles County. That's an average. Actual home prices for things that you would want to buy for people who work here are probably even less than that as a percentage. So people get, and given the tax rates in California versus the tax rates here, people in this office, generally speaking, make probably 25% more here after taxes than they make if they're living in California. And between that and buying a house and lower school tuition and 10-minute commute, and it's a lot easier, but it also doesn't have, it's not California.
Right.
I mean, so we just thought, you look at all the firms moving to Florida today from New York, and tax is part of it, quality of life is part of it. The business community here is exceptional. The network of super sophisticated family offices is as deep as I've seen in any city, including New York, and I would say quite a bit better. And so, but it's great in New York and it's great in California. And we continue to have a big presence in both of those markets, as well as London and Tokyo and so forth. But we felt like we needed to provide an alternative to people, and we also chose Dallas because, and by the way, Goldman Sachs is moving thousands of people into the city over the next couple of years after doing a pretty comprehensive study of a dozen cities. And there's a reason. So we felt like we had to offer people an alternative. Miami was a little bit of a bridge too far for people from California. It's 2.5 hours to either coast, any city in the United States. So it seems to be functioning well, and the morale in the office is A+. So
great.
We'll see.
Yeah. All right. I know we're sort of getting close to time, and we could go on for hours because it's so fascinating just hearing your insights and stories. But let me see if I could just squeeze in one or two more questions. One that I've been meaning to ask you for a while is, when you look back on your illustrious career, what would you regard as sort of the most valuable and instructive mistakes you've ever made? And as a result, what advice might you have given your younger self?
Well, I think we didn't have a very well thought out business plan. And I also think that, you sometimes do what you want to do and you don't listen to the market as much. And I think we're better at listening to the market. So I think when you're starting a business in the finance world, it's easy to say, well, here's what we want to do, and we do this well, and that's it. You have to keep your antenna up and be a little more nimble than we've been probably over the years at creating products that you have to match what you do really well and where you add the highest value with what your clients actually want and need. You can't just do kind of what you like and then hope that they'll, it's like Field of Dreams. Yeah. I give my kids, so that's kind of in terms of professional things that I wish we had early. It took us a long time to get out of the blocks and really get our business going because we weren't listening to the market. We weren't talking to the right investors. We just said, oh, people should do this because it makes sense. Well, if you don't explain it to them and you don't have a product that they actually want to buy, you're not going to get the kind of traction in your business. Yeah. My kids, look, you want your kids to be engaged with something they love to do. You hope they have a great partner in life that's going to be there forever. You want them to be honest. You want them to get that sense of satisfaction that they've done something productive and contributing to society and to their own sort of sense of gratification and dignity on a daily basis. So you want them to have a job they love, whether it's as a French horn player or as a construction worker or as a manager of a private equity fund. And I tell my kids, they always laugh at me because I give them the same 3 pieces of advice. I go, work hard, be honest, have a positive attitude. And I tell them, look, you can't control your IQ, maybe here, maybe there. But, if you work hard, generally speaking, you probably do better, right? Be honest. You can, and you see this all over the map with businesses. You can destroy in a day what you create in a decade if you're not honest. And the hardest one of those 3 things is to have a positive attitude. If you are a glass half full kind of person, and by the way, credit guys are glass half empty guys because you're always trying to figure out how can I lose money, and the best thing that happens is I get par, I get my money back, right? So, but you got to be a positive person because if you're a positive person, people will want to spend time with you and they'll follow you, and you can have all the gratification and the success that can bring. People don't want to hang around with glass half empty people all the time. So those are my little dumb pieces of advice I tell my kids, and I try to live those myself, but I don't always do it.
Yeah, I know those aren't dumb pieces of advice. They're great. So let me end with one last question. When you think about the best piece of advice that anybody has imparted on you, what comes to mind?
Oh gosh, I don't know. My dad was so full of good advice. but pithy advice, like the advice I was giving you at the beginning. You have to have your own business. You have to have your own business. I mean, all those little things in the back of my mind from my dad were just great pieces of advice. Then he had other ones too. He'd say, like, don't go into politics. They ruin you if you go into politics. It's like, he's kind of right. He was ahead of his time on that one, right? Study hard, go to this school, do this, do that. His advice was pretty good for the long run. And it's hard to. I mean, I am so privileged to have had such extraordinary guidance and advice from someone who wasn't really positioned to give me that advice. Because as I said, he wasn't college educated. He didn't have connections and know this job or that job. He had no idea, but he had a basic formula for what he thought would make me happy and gratified in my career. And yes, it's been financially rewarding, which is, I'm sure, what he was thinking about, because he grew up in the Depression with one parent because his dad died when he was very young. But for me, that's almost like a byproduct of having a rewarding life in other ways every day. Yeah. That's sort of usually how it is, right? So I think all of his pieces of advice were good ones, at least for me, because they resonated with me. The other thing is, you got to keep yourself engaged in things that have nothing to do with what you're working on every day. And I do a lot of that. Very, very engaged in the sciences these days, particularly with my alma mater. I love these nonprofits. I have to cut them down because I'm involved with too many of them. And I've been doing that because then you can focus and do a good job on them. But you always learn something, and you got to keep wide peripheral vision. So it makes life interesting and makes you successful.
Josh, that was fantastic. Thank you so much for joining us today, for sharing your incredible insights with us. And I really can't tell you how much we appreciate your generosity of time and wisdom. And so,
thank you, Mo. And thank you, Mo. And thank you to your firm and to all of the people who were willing to tune in and listen to all this stuff. So thank you.
No, this is great. And I certainly hope we could do it again soon. And for all our participants, thank you for joining us. If you haven't donated yet, please do so by going to the donate page, the top right of the site. And so we could continue strengthening pediatric mental health in our communities. Josh, thanks again for your support of Lunches with Legends. We wish you and everyone else on this call a wonderful day. Thanks, guys.
Thank you, Mo. Thank you, Prime Quadrant. And thank all of you.